Dinesh, Kumar Khara, who's MD of SBI, joins in with his take on what is expected. Mr. Khara, it's great to have you on the show. Thanks very much for taking out the time. Good morning. What do you think the industry needs right now?
Good morning to you. Well, I think it's a bit of a situation where, as far as the inflation numbers are concerned, the CPI, of course, is quite benign. It is at around 2.6. But if we look at the core inflation, it continues to be at around 5.7, 5.8. So that is one of the concerns. Then the other concern is, of course, when it comes to the global factors, the global slowdown is almost imminent, and the crude prices being the other factor, and crude price is quite benign. So if we look at the combination of these factors and also the fact that the growth in the economy is also a bit subdued, it is around 7%, and there is, on the face of it, it looks like to be a case, but if we look in a little deeper in terms of, if we analyze it in terms of inflation expectations, well, of course, the interim budget which has got announced, it has also indicated the spending which will involve funding something like 79,000 odd crore through the small savings, and another 15,000 crore, or almost about 15 to 19,000 crore are expected to be raised through the long dated papers. So that's the kind of a scenario in which the policy announcements are expected in this backdrop. So to my mind, one, of course, is we are expecting that stance will certainly is expected to change, where very strong probability of change in stance from calibrated tightening to softening of the stance. That is almost certain. We would not be overtly surprised if at all there is a 25 basis point cut, but then again it's a very thin balance which RBI will have to probably make it. So I think when we look in terms of the bond prices have almost factored the stance in terms of softening. Some of the bond traders seems to have even factored about 25 basis point cut also, but not majority, but some of the traders. So that's the kind of a situation as I gauge as of now.
If one works with the assumption that there is a rate cut, if there is a rate cut of 25 bips, what will that change to the underlying demand? Because ultimately RBI also has to manage inflation, monitor growth, and ensure that the cost of borrowing in the system does not go higher. So if there is 25 basis rate cut, do you think that's just going to be academic in nature and that will not do anything in terms of demand or anything in terms of kick-starting a new cycle?
Well, as far as credit demand, we have of course seen kind of a growth for last about 4 months time. Of course, January we did see some kind of a sluggish growth in the credit, but I would say that from October onwards there was a definite improvement in the credit which was seen. I would say that deposits are growing at a slower pace even for the all scheduled commercial banks also, as compared to the credit growth. But of course, there were certain disturbances which were witnessed in the NBFC space in the last quarter of the last calendar year. So that is something which might have an impact on the credit disbursements. SME, of course, started seeing some kind of a positive credit growth also. So I would say that multiple factors which are there, but when it comes to impact of this 25 basis point on the demand side, see, essentially the policy rates offers you the kind of a liquidity which would be short-term liquidity. So if at all there is a softening of the interest rate, of course, the liquidity flow might go up, but having a significant impact on demand, I don't think I would subscribe to that idea.
Why is it that you believe that there's only a slim chance that there would be a rate cut by the RBI today, along with the neutral stance? Is it because inflation is much under control, or are there other reasons you would attribute to that?
No, I would say that, of course, when it comes to the consumer price inflation, that is okay, fine. It is at around 2.6, 2.5. But if we look at the core inflation, that still continues to be at around 5.8, 5.9. That is one factor. The second factor is the budget, interim budget, which has got announced, where it has talked about at least almost about 100,000 crore rupees to be spent, and also the fiscal deficit to be at around 3.4%. So that is the kind of expected number for the financial year 1920. So there is it appears that maybe, if at all, inflation expectation is something which is weighing the decision, then possibly there could be a chance of inflation inching up also. So if at all that is really weighing too much on the mind of the policymakers, then possibly they may not go for any kind of further reduction. But yes, of course, if growth is something which is a cause of concern, yes, of course, then I think there could be so that's why I'm saying that it's going to be either or situation, but it's going to be a very thin line between the decision which will be taken today. So we are all very keenly watching it, how it really pans out.
Okay. Mr. Khara, we leave it at that. Thanks very much, sir, for joining us and giving us your expectations from the upcoming policy review. It's an important one.
Thank you.